Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. In today's webinar, we're going to assess the state of the U.S. consumer. Let's start by looking at what's driving the slowdown in U.S. consumer spending, and we'll wrap up by discussing what it means for the U.S. economy and the performance of the S&P 500. If you have seen previous webinars, you will know that we encourage our users to challenge the headline news stories you see on the internet. Mainstream media has been reporting all year that the U.S. consumer is healthy and resilient, and on the surface, this appears to be correct. For example, on Monday, October 17th, Brian Moynihan, the CEO of Bank of America, says the latest spending and savings data show that the U.S. consumer is healthy. As late as November 21st, the World Economic Forum suggested that the consumer spending is proving to be resilient in the face of surging inflation in the U.S. It was not until Jamie Dimon said on December 6th that inflation eroding consumer wealth may cause a recession next year that investors really started paying attention. In late November, the Wall Street Journal ran the following series of articles centered around the rapid decline in savings rates and the return of credit card balances. The articles highlighted that the declining savings rates and the return of credit card debt could be a risk to future spending. Good news is, for those of you who subscribed to our research lab and read the following June 15th market strategy piece, you already knew that the increase in revolving credit outstanding, coupled with the decline in personal savings rate, would result in consumer spending and consumption risks going forward. The June 15th Pacific Point Research Lab market strategy piece included the following segment on the decline in real wage gains, personal savings rates, and the increase in consumer credit. The blue line in the chart demonstrated at the time that the 1-year percent change in the personal savings rate had dipped to 4.4%, to levels not seen since 2008-2009 financial crisis. We identified that this was the result of annual wage gains failing to keep up with the annual change in inflation. We further stated that the data suggests that many consumers are stretched and using savings and credit cards to make household purchases. This was evidenced by the purple line illustrating the annual increase in revolving credit outstanding of 19.6% was offsetting the decline in the personal savings rate. This is a typical trade-off or inverse trend we see when consumers are under financial stress. The following chart is an updated chart from our June 15th market strategy piece with one key change. We've removed the 1-year percent change in revolving credit outstanding and replaced it with the total consumer credit outstanding, also in purple. Note the inverse trend remains intact and becomes even stronger now that the 1-year percent change in the personal savings rate, the blue line, has fallen to record low levels of only 2.3%. In this next chart, we're going to expand our analysis from the previous slide and bring back the 1-year percent change in the revolving credit outstanding as an overlay in green. Please note the area of the chart circled in red illustrates that a troublesome scenario is playing out for the U.S. consumers, as the 1-year percent change in revolving credit outstanding is actually leading the 8.1% annual increase in total outstanding credit to record high levels. This increase is being led by high interest credit cards and HELOC loans and is likely to dampen future consumer spending. We continue to see evidence of consumption on the decline. The following chart illustrates the 1-month percentage change in consumer spending, which declined 0.6% in the month of November. When this number was reported last week, it triggered a large sell-off in the market. This was no surprise to us at Pacific Point. As you can see, the trend in consumer spending has been downward sloping all year, and it may get worse before normalizing. Why does personal spending matter? I would like to remind everyone with the following chart that personal consumption expenditures represent almost 71% of real GDP, and this has been on the increase since the beginning of 2021. You can see this illustrated here with the red arrow inside the red circle toward the right-hand side of the chart. U.S. personal spending and consumption matters now more than ever. In the following 3-year chart, please pay particular attention to how the mean reversion of the 1-month percent change in the S&P 500 in blue tends to track the 1 month percent change in the leading economic indicators in green over time. The red trend line illustrates that on average, the U.S. Conference Board leading economic indicators have been on the decline since the start of the year, mirroring the deceleration in consumption and personal spending. On Thursday, December 22nd, the U.S. Conference Board will report November leading economic indicators. Consensus calls for a decline of 0.5%. I'm going to leave you with this thought. To the extent that leading economic indicators continue to trend down, how much further does the S&P 500 have to mean revert to the downside from its most recent bear market rally? That's about it for today's session. Thank you for attending, and be sure to join us next time.